For us, it means we're going to continue to pursue sales of assets within our portfolio, primarily out of our urban markets. And we'll use that capital, recycle it into buying our stock back, which is trading at about half of our published NAV for the company. And then we'll pay down debt along the way for the EBITDA that we sell.
San Francisco is definitely a bright spot in your latest earnings report. What are the various factors behind that, and will they remain in place for 2026?
Wow. So San Francisco is like a long story that I'll try to make short. People got fed up with the way San Francisco was run. Business and the community groups got together, elected people who are more pragmatic and more competent with better policies. So the city is recovering rapidly, has great momentum in all areas: cleanliness, crime, quality of life on the streets. Retail is coming back. People are coming back to the offices. Leisure is returning to the city. The convention calendar has gotten significantly better. We've recaptured conventions that left the city, went to Las Vegas or some other city. AI it's obviously the big thing in San Francisco, right? AI is headquartered in San Francisco. Companies are moving in to San Francisco, leasing space, growing rapidly. Will that continue for 26? Yes. We think it'll continue for the rest of the decade. We think that's how powerful. This is a technological revolution that we think has a lot of legs and is completely headquartered in San Francisco. So we're extremely excited about the recovery in San Francisco.
And what are you seeing in the transaction market today, and how is it impacting Pebblebrook's capital allocation strategy?
So the transaction market has been through sort of an up and down year, with driven a lot by the impact of policy, governmental policies that either created uncertainty or created enthusiasm, and then went back to uncertainty and then enthusiasm and back and forth. And because transactions tend to take longer, didn't really provide a great runway for a lot of activity. It's been picking up over the course of the year. We just closed on 2 sale transactions, one in Chicago, one in Los Angeles, 2 difficult cities to sell into, where we found high net worth individuals who were excited to be active in the hotel industry. We think that picks up steam over the course of next year, provided we don't have any of this up and down crazy impacts on the macro scene from policy. We think the economy is very resilient and should keep going. And so we think the transaction market becomes even more active next year. For us, it means we're going to continue to pursue sales of assets within our portfolio, primarily out of our urban markets. And we'll use that capital, recycle it into buying our stock back, which is trading at about half of our published NAV for the company. And then we'll pay down debt along the way for the EBITDA that we sell. So it would have a big impact on our company and our activity, but continuing to do the same thing from a capital allocation perspective.
And given ongoing volatility in urban demand, do you anticipate shifting more heavily toward resort markets, or do you see urban recovery as a near-term opportunity?
Yes. Yes to both. I think our resort share of the organization, of the company, will continue to grow, primarily because we'll be selling down urban properties to take advantage of our stock price. We think that the urban markets have, over the last maybe 5 to 10 years, they've added risk and they haven't added return. And so while we think there's a very healthy recovery underway now in places like San Francisco, which we talked about, in Chicago, in Portland, in Washington, D.C., interrupted by DOGE and the government shutdown, we think that'll continue and in some places accelerate, like in San Francisco. So we're excited about the recovery in urban, but we think for the long term, we'll rotate more of our portfolio into the resort category and out of the urban category.
And what trends are you anticipating more broadly for the lodging real estate sector as you look to 2026?
So there are really four different trends that we're looking at for 26. First of all, we have a uniquely active event calendar for the U.S. next year. We have the World Cup coming here in many, many cities in the U.S., bringing in people who tend to spend a week to 2 weeks to maybe even 3 weeks here, spend a lot of money, stay in hotels. Great for the country overall. We have our 250th anniversary of our country. A lot of activities in major cities around the U.S. We think that'll be great for domestic travel in particular, and any Americans living outside of the U.S. who may want to come back for those activities. We have an incredibly positive calendar as it relates to where the holidays fall. You know, holidays that fall midweek tend to be a big negative impact on hotel travel. Groups don't meet, people don't travel for business. And next year, most of the holidays fall on the weekends, whether that's Halloween, which we think should be permanently on the weekend for everybody's benefit, families included. We've got Valentine's Day on a Saturday. We got July 4th on a Saturday. I mean, we have the Jewish holidays primarily on the weekends. So next year falls really well, where there's less interruption to business travel and reasons to actually do weekend travel as it relates to having those holidays or long weekends for that. So that's another trend we see. We think the World Cup will help reinvigorate travel back to the U.S. You know, we've kind of turned off a lot of countries and people around the world in the last year. We think people will come back for the sporting event. The administration has pledged to make it easy to get in the country, to welcome people here. And so we think that'll help reinvigorate people who say, God, America's such a great place. There's so many super things to do here, and I had a great experience, and I want to come back, and I want to tell others about it. So we think those are the big activities. And if we can have just 1 year here where we don't have major policy impacts on the economy and creating uncertainty, we think the economy is very resilient. And there's a lot of capital investment being made next year and the year after. So we think this economic period this growth period has legs. And with an environment where we have very little new supply for the next 4 to 5 years in the hotel industry, we think we have some great times coming. We just need to get a little stability.